Okay, so I will just take 1 minute to introduce Oleg. So welcome everybody to this lecture of the Chair Banque de France at PSE. So this is part of the activities we do in this chair. So last month we had Ricardo Reis. In 1 month we are going to have a lecture by Jordi Gali. And today we're very happy to have Oleg for a lecture that has been postponed several times because of COVID, but we still hope to have you in PSE soon. So thanks a lot, Oleg, for accepting our invitation. So Oleg is a professor of economics at the University of California, Los Angeles, and is also a research associate at the MBR, CPR, and associate editor at the American Economic Review. So the paper is going to present today is revised as admitted QJE, if I understand well. So we are all looking forward to listen to you. So Oleg, you have about 1 hour for your talk, for the lecture, and then the discussion will be given by Giancarlo Corsetti from Cambridge, that we also thank a lot for accepting the invitation. So Oleg, the floor is yours.
Thank you so much, Francesco. Thanks for the invitation. Thanks, Giancarlo, for discussing the paper. I mean, I was really hoping this would be in person, so that's why we postponed it a couple of times. So when we first started looking at the pandemic data, it was more than a year ago, last February, we kind of calculated based on the simple dynamic models that everybody started playing with that, you know, by April, we for sure will be able to travel to Paris. But I guess the pandemic taught us a number of lessons. And yeah, no, so I'm hoping we kind of like turn in the corner and hopefully next fall will be in person. But I mean, I'm still very happy to be here. I wish I were in Paris right now, but nonetheless. So this is a paper with Mary Amiti and Joep Konings, my repeat co-authors on these topics. And this paper specifically is about dominant currencies. So to give somewhat a broader introduction, it kind of feeds into the topic of the sort of overall dominance of the dollar in the global markets. There is a nice survey paper by Piero Viagorinches a couple of years ago called The Dollar Hegemon. The idea is that the dollar plays a central role in a number of areas, right? And so the area we will focus on will be in international trade and the goods market. And so in the goods market, the role of the dollar in invoicing trade flows between various countries is much, much greater than the role of the United States in the trade flows, right? As a country, as a trade partner. And so that's sort of the sign of the dollar dominance. And this recent framework of dominant currency pricing and dominant currency paradigm has been developed. In particular, Gita wrote a number of papers on it recently. And so this is the area where we will contribute. So we're going to sort of go into detailed micro data to kind of understand better the mechanism of how firms choose, you know, in which currency to price their exports and what are the consequences of that choice. So that's going to be the focus of the paper. But along with the role of the dollar in the goods market, dollar also is dominant even more so in the financial market. So when firms issue liabilities, whether this is bank credit or whether this is bonds that the firms issue, oftentimes they do it in dollars, especially if you want to access and tap the pool of international investors or international banks. And so dollar plays a big role in the financial market. The monetary authorities use dollar as an anchoring sort of currency, anchoring device, even if like there are many countries that peg directly to the dollar, but even if countries don't peg to the dollar, they can have sort of like either imperfect pegs, dirty pegs, partial pegs, and dollar is the currency of choice for pegging as well. And finally, dollar is the currency of sort of safe assets. International reserves are held in dollar government bonds, right? And so the idea is that these are different areas, and likely there are strong or possibly strong, this is actually an open question, strategic complementarities between choices to use dollar in these different areas. So we will zoom in specifically on trade. That would be the purpose of this paper. So what do we know about currency use in international trade? What's its role? So there are two important consequences of the currency use in international trade. So first of all, it's central for the transmission of shocks. And second of all, it's a crucial input in our understanding whether it's optimal for countries to have a floating exchange rate, a pegged exchange rate, and overall exchange rate and monetary policy. And so it's actually quite intuitive here. You know, if your prices when you export are set, if you're in a European country and prices are set in euros, this will lead to pretty efficient expenditure switching, because whenever exchange rate moves, this will, if exchange rate depreciates in particular, it will shift expenditure towards the domestic goods. And oftentimes we think that could be sort of an efficient feature built into floating or flexible exchange rate adjustment. And that's also the reason why in such models, actually floating exchange rates could be optimal, right? So, but now imagine that when you export, you don't fix prices in the producer currency, and you fix prices in a dominant currency, which says the dollar. In that case, the expenditure switching will work very differently. Depreciation of your own currency will not do very much for expenditure switching. It would be all about the movements of the dollar exchange rate, right? That would affect expenditure switching between different countries. And in particular, an important insight in this literature is that if dollar appreciates, that's like a negative shock for global trade. No matter which two countries trade, if they set prices in dollars and dollar appreciates, it's like a negative shock for world trade. And that could be like an amplifying mechanism in global recessions if the dominant currencies tends to appreciate in global recessions, right? And similarly, because of that, floating exchange rate is no longer necessarily the optimal policy because it doesn't achieve efficient expenditure switching. And so this is why this topic is of broad macroeconomic significance. So in this paper, these are the big questions on which the literature has made progress. Our focus would be mostly empirical in this paper. And so basically we will look at sort of like zoom in at the decisions of the firm. And so what we have already known from the previous literature is that currency choice is a pretty active decision at the level of the firm. So when you look in the cross section, you can study currency choice from looking at basically which types of firms adopt which currency in their expert pricing. And so as a result, we kind of can conclude that this is really an endogenous decision at the level of the firm. And that's, we're going to make more progress on that dimension. At the same time, we kind of also know that currency equilibriums are extremely persistent over time. So we're talking multiple decades, right? That, you know, the same currencies remain the dominant currencies. And so we're going to try to sort of investigate into the mechanism of why currency choice stays so persistent over time. And so this would be the area on which we focus. The area on which we would not be able to focus, you know, given our data and so on, but these are the big questions. And so our estimates would provide sort of input into future analysis. Is the following question is like, what are the welfare benefits to having, you know, a dominant currency? Is there a big welfare benefit from trying to sort of promote your currency, whether it's the euro or yuan, renminbi in China, to the status of a dominant currency? Or from the point of view of the welfare of the country or the region, it's not really a big deal. So these are kind of questions that are open in the literature. We don't have clear answers to those. And also the other one is, what are the macroeconomic consequences to a switch from one currency to another currency, right? Okay, so these are the questions that are these big macroeconomic general equilibrium questions. We would not be able to answer them with what we do in this paper, but we would provide input to discipline in the general equilibrium frameworks that people can use then to answer those questions. Okay, and finally, we're going to focus on Belgium. And I'm going to argue that, so Belgium will be the source of our data. I'm going to argue that Belgium is actually fairly unique, and it's actually sort of in a way an ideal exercise, ideal laboratory for the type of the exercise that we want to do. And the reason is the following. So first of all, when you look at Belgian experts, and we will look at Belgian experts outside of the Eurozone, outside of actually European Union, so it's sort of experts far away, experts to countries like Japan, United States, China, India, and so on, right? So when you look at those experts, there is a very healthy mix of currencies in that experts, right? So it's not just dominated by a single currency. In fact, we see a big share of the dollar, a big share of the euro, and actually a sizable share of the destination currency as well. So we kind of have all possible choices that we expect firms to make with their currency choice. And that's why by looking at the cross-section of firms, we'll be able to study the determinants of currency choice. And we can also look at the time series to see the implications of currency choice for, the consequences of currency choice for price and quantity dynamics of these firms. So that would be what we're going to do in this paper. And so obviously, the necessary requirement for that is that we have very detailed micro level data. And in fact, you need to have multiple data sets, which you have to sort of connect at the level of the firm product. So you need to know information about the firms. You need to know information about, export status, like how much they export, to which destinations, which products. And separately, typically it's a separate data set. You need to know the currency in which they do exports and so on. And you have to kind of link and merge across the data sets. And Belgium is sort of a pretty amazing source of firm level data. And so that's why there's been lots of papers written with Belgian data, sort of looking at different dimensions of relationship between firms, right? So from my conversations yesterday at Banque de France, and I mean earlier literature, so French data is of seemingly similar quality. And so some studies have already been done in France, focusing on related type of issues. And so in principle, many European countries will have, this type of data to make further progress. Okay, so this was a lengthy introduction, and I will overview quickly the results and then jump into what we actually do. So first of all, by looking at the data, we'll see that, symmetric frameworks. And so the interesting thing is that the theoretical literature in international macro, before this type of data were available, it adopted a symmetric framework, which makes a lot of sense. And the two symmetric frameworks are producer currency pricing, where exporters choose their own currency, or destination or local currency pricing, when the currency is chosen depending on which destination the goods go. So those frameworks don't seem to describe the data well, right? And so the salient feature of those frameworks is that the relative role of different currencies in the world should be roughly proportional to the size of the country in international trade, right? And this is not something that we see in the data. So we see in the data is a very dominant use of a small handful of currencies. And in particular, we'll see that, dollar looks clearly as a global dominant currency in this regard. And euro looks like a established regional currency with perhaps dominant currency aspirations as well. And I'm kind of show you the data, how you can just directly see it in the data with not much of a statistical analysis, really. So then we're gonna dive into currency choice. And so the first result we'll show there is that much of the variation in the currency use actually happens at very micro levels, right? It happens within detailed industry destinations. So it's not like some industries are dollarized, some countries are dollarized. It's more within any industry destination you look at, you'll see firms adopting dollars, adopting euros, adopting destination currencies. And that would be the level of our analysis, basically. We'll study variation across firms, why they adopt different currencies. And so what we'll show is that the determinants of currency choice that are predicted by theory are exactly the ones that seem to be the key determinants in the data as well. So not surprisingly, import intensity of the firm, to which extent the firm relies on imported intermediate inputs, and in particular, when it imports it in foreign currencies, and in particular, when it imports it in dollars, is a strong determinant of the currency choice in exports as well, and in particular of the use of dollars in exports, right? So this is not surprising. That's what we would expect from pretty much any theory, and that's a very strong effect in the data. The next effect that quantitatively is perhaps the strongest is the variation in currency use across firms of different size. And basically, firms of different size will systematically choose to use different patterns of pricing. And so this is something I'm going to focus a lot on as we go ahead. And then we'll find some other determinants of currency choice. One is kind of like a strategic complementarity variable. What do your competitors do? If your competitors are more likely to use dollars, you're also more likely to use dollars, controlling for other characteristics. And finally, the other variable that's intriguing is if you have cross-border ownership. If you, as a Belgian firm, either own something abroad, either own a subsidiary abroad, or you own by another firm internationally, you're much more likely to use dollars in exports, right? And so we kind of tentatively call it the effect of global value chains, that global value chain propagate the use of the dollars, but we don't have other variables other than ownership. And so at that level, it kind of remains a conjecture. Okay, and then what we will show, and I'll spend a lot of time showing towards the end, is that currency choice feeds back strongly into dynamics of prices and quantities in a way consistent with the sticky price models. So the sticky price view of currency choice, why does it matter whether you adopt dollars or euros? Well, because your prices are sticky for a pretty extended period of time in the currency that you chose. And so it mechanically affects the dynamics of prices in the short run before you adjust the prices. And then it feeds into the dynamics of quantities as well. So this effects on prices are also allocative. And so I'll spend time showing that. I'll try to establish the case that this is really not a selection of different firms doing different currencies, but it's really the causal effect of choosing dollars versus euros that results in differential price and quantity dynamics. And so it's consequential for macroeconomic allocations. So this is the overview of results. Last thing I was going to say here, so we build on a large literature, both theoretically and empirically. We try to do a good review of the literature in the paper, but obviously we borrow a lot of great ideas from the literature and kind of try to make the best given the new data set that we have in the paper. So let me see if you guys have any questions, and after that I'm going to jump directly into the analysis. Okay.
Please go on. We will collect the questions after the discussion.
Okay. Oh, really? I see. But also, please feel free to interrupt me with clarifying questions.
Okay.
So then I would know that you're listening, because otherwise I'm not sure on Zoom.
Okay.
On WebEx, I'm sorry. Yeah. So yeah. So what I will do, I will start with a theoretical framework, and it's actually going to be quite important because the empirical specifications we will do, they rely quite a lot on the structural equations that we derive, like reduced form kind of structural equations that we derive from theory. And I'll show you the data, and it was quite interesting to us that if you do not specify the regression correctly, you actually get strange results. And then once you go back to theory, you realize you forgot to include a variable. And so theory really kind of helped us a lot in deriving the structural equations here for the analysis. But at the same time, there is not much of an innovation in theories per se that we do here. So we kind of assemble different ideas from the literature and put them together to get to sort of a structural equation in the end. Okay, so the way I'm going to think about currency choice, so I will look at an individual firm level decision when a given firm serving a given product I is serving industry S in a destination market K. And I'm going to just drop the indexes for industry and destination because all of my analysis will be sort of looking across firms within a given industry destination. Both theoretically, I'm going to kind of look inside industry destination variation across firms, and empirically, I'm going to do the same by including firm product year fixed effects. So all the variation in my analysis will come across firms in sort of narrowly defined industry destinations. An important concept, and sort of in a way it was a breakthrough in this literature, is to define a desired price of the firm. So it's the idea is like if you could choose any price you want in any state of the world, so you will have a desired price in that state of the world. I'm going to denote it with a tilde. It suggests that this is the ideal price you could have, in this period when this exchange rate shocks have been realized, and these are the prices of your competitors that have been set. So this is the best price you want to set. And the nice thing about the desired price is you can go between any currency. So you can just add a spot exchange rate, and you can go from, this is, I think I've done in the producer currency, so in euros. So without anything, this is the price in euros. And then I can just use the euro country L or currency L exchange rate, and this will give me the desired price in any other currency, right? Because this is a static object, you just use the spot exchange rate to convert it between currencies, right? So then we're gonna assume that firms are subject to sticky prices. And so they have to preset a price. So for simplicity, I'm going to show you the static problem. It extends to a dynamic environment, and the previous literature showed how to do it. But I'm, for simplicity, just going to focus on a one-period price stickiness. It's without much loss of generality. So the qualitative insights would be, quite robust. And so, ahead of time, you have to commit to a particular price in a particular currency. So you have to say, I'm going to do it in currency L, and I'm going to set this price in currency L. And next period, when the shocks are realized, the state of the world is realized, this is the price and producer currency that will be realized, because I have to convert it from currency L back to euros. And I want to optimize an expectation before I know, what would happen next period. Perhaps I will have a probability delta, like a Calvo probability to adjust next period. Sorry, 1 minus delta to adjust. But if with probability delta I cannot adjust, this is the price that I will basically inherit from previous period. This is the preset price. And so this is the price that consumers will face. So I will have, I convert it first to euros, and then I convert it to the destination currency. And this is the price in destination currency, and I denote it with a star. This is the price that consumers will inherit, and it will basically move 1-to-1 with nominal exchange rate unless I adjust prices. And so now, obviously, there is this problem of, how do you choose optimal currency? Well, conditional currency, this is what you will do. And so now you just go currency by currency, and you say, like, let me try euro and see what would be my expected profits. Let me try dollar, let me try destination currency, and in principle, any possible other currency in the world, right? And so what you're trying to do, you're trying to minimize the loss between the optimal profits when you have the desired price and the expected profits that you will make with a preset price. And so this is a profit loss in a given state of the world, and you need to take the average across all possible states of the world where your price stays in effect. And this seems like a complicated problem, right? It's like, how do you even approach it? And in particular, I didn't say anything about the profit function. So it could be a profit of the exporter, it could be a joint surplus of the exporter-importer relationship, right? So at this point, it's a very general kind of abstract problem. We can also make it dynamic, as I mentioned, right? And so it kind of looks like a complex problem to characterize, right? And so the major insight in the literature was that there is an equivalence between solving this problem and solving this problem. Okay, and so this is kind of like a basically major breakthrough about thinking about currency choice, that it's not, you don't have to work with profits, which is a complicated object. Profits we don't observe. We can observe realized profits, but we don't observe it as a function, right? And instead, you can recast the currency choice decision in terms of desired prices. So, and the desired prices we defined on the previous slide, it's the profit maximizing price, right? And kind of mathematically, it's perhaps somewhat intuitive. If you know the properties of the price that maximize profits, maybe you know enough about profit function to characterize the optimal currency choice. And it turns out the answer is yes to that question. And in fact, the optimal currency choice just minimizes the dispersion of the desired price when it is expressed in that currency, right? So you'll choose currency L if the desired price in currency L is most stable compared to any other currencies, right? And this is kind of intuitive, right? When you do currency choice, then you're going to try to set constant price in that currency, but you are targeting a variable object. You're targeting a desired price that moves state by state. But if you will choose the currency in which the desired price is most stable, the target is moving less, right? So you have to shoot at a target that moves less. And so you'll choose the currency in which your target moves the least. This is pretty intuitive, right? The other way of thinking about it is like, what does a currency choice do? Once you, for example, commit to dollars, you will have zero pass-through into prices expressed in dollars, right? What does it mean that your desired price is stable? Well, if it's expressed in dollars, it means that your desired pass-through is small in that currency, right? And so sticky prices give you exactly a zero pass-through in the currency, and the desired price, you're going to choose the one currency which has the lowest exchange rate pass-through into desired prices. So this is quite intuitive, and in fact, if you do the algebra, this is just the result of second order Taylor expansions, right? And things just work out beautifully. Like you get a bunch of terms in those second order Taylor expansion to this, and you can manipulate it, and you can arrive to an expression of this sort, right? Okay, but why do we prefer expressing it this way rather than expressing it this way? Well, it turns out we would be able to measure objects like this in the data, and this is the reason why re-expressing currency choice in terms of desired prices is led to progress in the literature, right? And so, okay, so how do we think about it? Well, let's compare volatility of your desired price in euros and volatility in any currency L, right? Well, then you can express it like this. So this is the desired price in euros plus the bilateral exchange rate between euro and currency L. And then you can expand the variance term into, sum of two variances. And sum of two variances plus two covariances, right? And, this variance will be on both sides, so it goes away. And what do you have left? Well, you have a variance of exchange rate left and a covariance between desired price and exchange rate. And if you manipulate it, you're going to get this expression, right? And okay, this is beautiful because what is this? Well, this is a regression coefficient. So what it tells us is that we can actually learn about optimal currency choice if we could calculate this regression coefficient in the data, right? And so this is how we can calculate, if we knew desired pass-through, right, coefficient. The problem is, of course, we don't observe desired prices. We observe sticky prices. And the question is, can we extract any information from that? And so if you lived in a one-period world, it would be very difficult to extract information. If you didn't know for sure whether price is adjusted or not, you just observed some type of kind of average of adjusted and unadjusted price. But when you live in a dynamic world and you see that some firms adjust and some firms don't adjust, there is a way of extracting information about sort of what's the pass-through conditional on adjustment and what's the pass-through before adjustment happened. And you can actually learn about desired pass-through from the data. And so this is what previous papers have done. We're gonna sort of push it a little further here. So in order to make further progress, we need to understand theoretically how should we think about desired prices, right? And this is something, we had a previous paper with Mary and Joop, and that paper was specifically devoted to this topic. Is like, how can we learn about decomposition of desired prices and various components? What are the predictors of desired prices and so on? And so the idea is that in a very large class of models, you can show that, well, obviously this is in logs. So I should have mentioned, this is desired price in logs. So this is marginal cost in logs, and this is desired markup. And this is really just the definition of the desired markup. You can always, measure desired markup that way. And so what we show that in a very broad class of models, you can think of your desired markups as a function of your relative price, essentially. So you look at your price relative to the average price in the market, relative to your competitors in the market. And your markup is a decreasing function of your relative price, right? And so the idea is that, it works in a big class of models, but in a narrower class of models where you just have monopolistic competition, basically your relative price determines your location on the demand curve, on the demand, what's it called? Not the line, but it's a demand kind of multi-curve and a multi-space. I forgot the name, the mathematical name for that. So it determines your location on that multi-curve, right? And that location has a curvature. That curvature sort of determines elasticity of your demand, and elasticity of your demand determines the markup. That's kind of the intuition in monopolistic competitor models, right? In oligopolistic models, intuition is different, but you again get the same result. And in the oligopolistic models, this object determines your market share, and your market share determines effective elasticity of demand that an oligopolist is facing, right, as well. And so that determines the markup as well. So that's the intuition. And so then, given that, then what you do, this is a fixed point. And given that fixed point, you can characterize that the desired price, as a first order approximation, could be decomposed into a weight that you put on your own marginal cost and a complementary weight that you put on your competitor prices. So say you export to Japan, these are your competitors in Japan, right? So I convert it back to euro because I want to express it in euros. and this is your marginal cost in euros. And you will put certain weight on your marginal cost, and you will put certain weight on your competitors that you face in the Japanese market of your product. And some weighted average of this will determine your desired price, right? So, you know, it's like a convex combination that shapes your price, partly your own cost and partly what your competitors are doing. Interestingly, this weight that you would, you know, determine how much you put on your own marginal cost and how much you put on your competitors depends on the curvature of your markup function, the elasticity of your markup function. So if your markup function is constant, like CES, monopolistic competition markup, then this gamma is 0, and then you put full weight on your marginal cost. That's exactly what constant markup pricing is. You put full weight on your marginal cost. The more your markup is elastic to your relative price, the less weight you will be putting on your own marginal cost, and the more weight you will be putting on your competitors. And so that's kind of the key insight. So this elasticity, right, which depends on the curvature of your markup, is the cost pass-through elasticity. And this elasticity is the strategic complementarity elasticity, how much you care about your competitors. And these are the building blocks of a theory that we will use right now in order to sort of understand currency choice. So what we'll do, we'll basically project this desired price, the changes in this desired price on the euro destination exchange rate and the dollar destination exchange rate. And this is the equation that we will take to the data, right? And so here's the idea, basically. So if you are a firm which has no strategic complementarities, right? So basically, the way I will think about it is that this whole term, essentially the projection of this whole term, I will call it little gamma. And projection on the dollar, I will call gamma D, right? So if you don't have any strategic complementarities, this term is just 0, the whole thing. And so as a result, and imagine you also don't have marginal cost that moves with the exchange rate, that all of your marginal cost comes from local market. You basically only rely on wages that you pay locally, and wages are stable in euros, right? Well, what's the optimal thing for you to do? Well, the optimal thing for you is this one. It's a complete pass-through into destination prices from euro destination exchange rate. Well, why is that? You don't have strategic complementarity, so you want constant markup, and your marginal cost is in euros. And so as a result, your optimal price is just stable in euros, which means it moves 1-to-1 with the euro destination exchange rate when you express it in the destination currency. So when you export to Japan, you want your price to move perfectly with the euro yen exchange rate, and this is reflected in this one. So now, if you start importing foreign intermediates that are not stable in euros, right? You have to pay for foreign intermediate inputs that are not stable in euros. Well, this will make your marginal cost less stable in euros. And this is the object we will need to subtract. This is the guy we would need to subtract, interact it with the euro destination exchange rate. And what's that object? It's sort of the sensitivity of your marginal cost to exchange rate. And we'll be able to measure a proxy of that in the data by looking at what fraction of inputs that the firm is using in production are actually foreign imported intermediate inputs. And then we can look by currency, right? And so in particular, if you import intermediate inputs in dollars, it makes your marginal cost sensitive to the dollar exchange rate, and you will start putting a positive weight on the dollar destination exchange rate, right? This is the reason why the firms might care about the dollar exchange rate and eventually might want to price in dollars, right? And finally, same thing with strategic complementarities. The more strategic complementarities you have with Japanese firms, the stronger is this term, the less weight you will put on the euro-yen exchange rate. And so this will subtract. And so we'll have to find a proxy for that as well. And so if your competitors price in dollars, the more dollar competitors you have, the more weight you will put on the dollar exchange rate. And that would be another argument why you might want to price in dollars, right? And so what is the proxy that we will use for strategic complementarities? Well, in our previous paper, we showed that markup elasticity increases in the size of the firm. Bigger firms have more elastic markups, more variable markups, and they have stronger strategic complementarities, right? And so we'll use the size of the firm as the proxy for basically how much you care about what your competitors do, right? And so this would be the proxy for those objects. All right, so now how does the currency choice go? Well, essentially before that, yeah, currency choice, this is what I was gonna say here. Look, so if you are a firm like this, when you don't have intermediate inputs And when you don't care about your competitors, well, this is really the reason to choose euros, because you want complete pass-through from euro to destination currency. Choosing euros is the best thing you can do. The more you start to rely on intermediate inputs, and in particular if they are imported in dollars, the more likely you would want to adopt dollar as your export currency. The more you care about your destination competitors, and to the extent the destination competitors price in the destination currency. So when you sell to Japanese market, if many of the firms use yen in the Japanese market to keep their prices stable, the stronger is the desire to adopt destination currency pricing. And so these are the ideas that we will use to figure out the currency choice in the data. That's exactly how we kind of gonna make progress on that. And so then when we look at pass-through, you know, we're going to explore how movements in different exchange rates affect prices and quantities. So basically, when we observe prices, we know that a fraction of the prices is sticky still, a fraction of prices is flexible. When it's flexible, it's sort of adjusted towards the desired level. When it's sticky, it just depends on which currency it is sticky, and then it moves just with the nominal exchange rate. And so if we take it, you know, if we push this idea to, you know, estimating equation, this is how estimating equation should look like. So we would want to regress changes in prices in destination currency on euro destination exchange rate. And if firms do not import and don't have strategic complementarities, we'd expect a coefficient of 1 here. That's what we can test in the data.
Sorry, Oleg, can I interrupt you? Yeah,
yes, please.
In what you just said, so it means that the firm actually doesn't select the intermediate input as a function of what they are choosing as a currency, right? So you are choosing your own currency by taking as given the correct?
Well, the big fixed point probably would involve that choice as well, that you actually also choose what type of intermediate inputs from which countries to source it and so on. Yes, so in that sense, it's sort of like a fixed point. Both variables are endogenous, right? We just think that they live at different frequencies, that the currencies from which you import, this is sort of like a pretty long run decision. So you choose from which currencies, from which countries to import. And after that, you operate in that environment for a pretty extended period of time. It's not a choice that you make each time you set prices. The currency choice is the choice that you make each time you set prices. And so in that sense, it's true that there is this sort of dual feedback. If you chose dollars, you'd probably choose different source countries for your inputs. But we just think that we can kind of take it as a different frequency. And so we can think of, that you import in dollars as a determinant. The more correct way, of course, like theoretically pure way of thinking about it, that we are characterizing equilibrium relationships. They're not necessarily causal. That we see that firms that import more in dollars also export more in dollars. It's an equilibrium relationship. And the way to kind of proceed then, you want to write an equilibrium model with that big fixed point where everything depends on everything. And that big model will predict a correlation. And we'll be able to discipline the model with the correlation that we observe in the data, right? So it's not, you have to be a little careful interpreting it causally. We really characterize patterns of correlations. At the same time, there is a way to say that some choices are done at different frequencies. So you can, use that as like, sort of like an ability to make a more causal statement, but really to be theoretically pure, these are correlation statements. Yeah. Okay. Yeah. Very good. So then the cool thing is that we can split the sticky price determinants and the flexible price determinants. And so sticky price determinants is just like, well, you chose the euro. So if your prices are sticky for a while, and delta is the kind of Calvo probability, if you wish, of prices being sticky. So to the extent your prices are sticky and you chose them to be in euros, right, then this will have effect on the dynamics of prices and quantities in the short run, right? And so here's the indicator that you choose something other than euros. And this is the euro destination exchange rate. And it would come, with a sign minus here. And so it would subtract this delta from 1. And so the pass-through of a firm that chose non-euros would be, instead of 1, it would be 1 minus delta, reflecting the fact that, 1 minus delta is actually the probability that you will adjust your prices eventually. So delta is the probability that you don't adjust prices, and it's in currency other than the euro. And so this would kind of translate into short run sort of determinant of pass-through for these types of firms. And this is something we can estimate in data, right? And we can actually do it at different horizons. And what we know is that over time, H would be horizon. And so over time, this delta that I have here has a structural interpretation. It would be a function of time. So as time proceeds, the sticky price components have less and less effect, and you have more and more weight on the flexible price components. Why? Because over time, firms start to adjust. And so, here's the dollar, for example, determined. If you chose the dollar, in the short run, you'll be mechanically sensitive to the dollar if you stick in dollars with the weight delta. Gradually, you will put less and less weight on the dollar exchange rate for that reason, but you can start putting more and more weight for other reasons because you import intermediate inputs in dollars, right? And so these are the flexible price determinants now, right? That, over time, prices reflect more and more the flexible price determinants of prices and less kind of the currency choice in the short term. And so this would be the basis for our empirical analysis. And Francesco, I have about 20 minutes left, right? 25. Okay, good.
Yes.
So with this, so this is the theory. This is exactly the theory that we're going to take to the data. And so now, I mean, in a way, this is the more fun part. I probably should have started with these pictures. But, now I'm going to show you what we have in the data. And so, yeah, so as I mentioned, we had to link 3 different data sets. These are data sets on firm characteristics. And so this is how we can connect across data sets. So we have data from customs, and then we have the data on currency choice from the central bank. Data on trade and currency choice from central bank, and additional data on trade from customs, right? And so you have to kind of connect the 3 data sets, and this is what we'll do. So we'll be able to construct currency choice variables from this data, in which currency you set prices, whether it's euros, non-euros, or dollars, or any other currency. We'll be able to construct unit values, our proxies for prices. We'll be able to construct import intensity relative to all. This is important. So different firms put different weight on labor inputs versus intermediate. So we'll be able in this data to calculate total variable inputs. Lose you for a second? No, you can hear me, right? Okay, yeah. Yes. And so we'll be able to construct import intensity of the firm, how much it imports from outside of the European Union relative to the total variable cost of the firm. And we're going to be able to split it by currency of imports, whether it's in euros, dollars, or any other currency. We're going to know stuff about the size of the firm and stuff about ownership of the firm. So this is kind of our data. Okay, let me show you a couple of things in the data. So this is the table I actually like staring at. It kind of just shows the role of euro, dollar, other currencies. And so I will focus on exports, right? And so this is transactions, count of transactions, basically. And this is share in the value of transactions. And so if you look, so this is interesting. This is the same thing that Julia and Antoine showed me in French data yesterday. It's like you look at the transaction level, and I mean, it seems like there is no question that euro is a totally dominant currency. It's like 2/3 of transactions, export transactions from Belgium outside of European Union. So it even takes UK out. It's like all countries out. So I mean, Switzerland is in, but it's like far countries, right? And you still use 2/3 of the euro in your exports. And this is the sign that euro has become a dominant currency regionally, not just inside the European area, right, which or euro area, which uses the euro, but actually with most countries that European countries trade outside of EU, the transactions are disproportionately in euros. But as soon as you switch to value terms, if you weight the transaction by value, the dollar becomes bigger. It's more than 50% of Belgian exports are in dollars. Similar for imports. And so the idea is that the bigger transactions are actually more likely to be in dollars. And this is a very strong fact that we'll see next. All other currencies account for just 20%. Oh, for just 10%, I'm sorry. But the interesting thing, of course, that all commodities or commodity-like goods, non-differentiated goods, are disproportionately in dollars, right? And so once you take out the non-differentiated goods and you focus on basically manufacturing or differentiated goods, and this would be our sample, right? Then you see, that's what I call the healthy mix for Belgium. It's like 40% euro, 40% dollar, and 20% other currencies, which in most cases are the destination currencies. And you can sort of see a similar pattern for imports, right? right here. So this would be our focus. We're going to focus on differentiated manufacturing goods because this is where currency choice is most meaningful, because for commodity-like goods, prices are more flexible, and so currency choice is less meaningful actually to study, right? Okay, and so this is like a huge share. This is the disproportionate share of Belgian exports is really these goods, right? Okay, so now just to visualize this, I kind of like these pictures. So let's say we focus on exports, and this inverse diagonal, if the share of dollar and euro sums to 1, you'll be on that diagonal, right? So all the dots are the destination countries, and the size of the dot is the size of the destination market. So, you know, most of the countries you can see are on this inverse diagonal, which means that they exclusively import in euros or in dollars from Belgium, right? And so the countries can be closer here. It means a stronger use of dollar. Not surprisingly, one of the big trade partners is US because it's a big country. And so it's, you know, to a large extent, only in dollars. Well, 75% dollars, 25% euros. Interestingly, here's India, which is even more dollarized. Exports to India are even more dollarized. But then, you know, you have pretty big trade partners here, and many of them are close to Europe. So it's countries like, you know, Switzerland and Turkey are these two, right? And this is Russia. So actually turns out to be a big trade partner for Belgium as well. And, you know, the interesting country for us is Japan and China right here. And so you see these countries are kind of far away from the diagonal. It means that you use quite a lot of yen when you export to Japan. In fact, yen would be the most common currency in which you export to Japan. It would be more common than euro or dollar when you export to Japan. There are not that many countries like that. Japan is the biggest outlier. But, you know, there are some countries here where you use other currencies. And actually, interestingly, China is one of them, right? I thought China would be more on the diagonal. When you import from China, you're very close to the diagonal. But when you export, you're already starting to use renminbi. And this was kind of interesting for me to see. And by the way, this data is from, the currency data is 2017 through 2019. So it's 3 years, 17, 18, and 19 of currency data that we have. Okay, good. You know. All right, so I'm going to skip this. Basically, here we show that a lot of variation in currency choice. This is like a, you know, variance decomposition. So basically, we show that the variation really comes when at basically firm destination fixed effects. They explain 85% of variation in currency use. So it's really kind of seems to be a firm level decision. You kind of need to understand what are the firm determinants of currency use, right? So different firms choose different currencies, even when they sell in the same industries. Okay, so this is the picture on currency choice that I will show you, and then I will move on to the analysis of, the dynamic analysis of dynamics of prices and quantities. Okay, so this is actually a very stark pattern. So infrequently you see such strong relationships. I think like whenever I did bin plots in my previous research, you know, it's kind of hard to see such a strong relationship. But, you know, firm size tends to correlate with everything that you measure. But, you know, typically that correlation is not super strong. Oftentimes the correlation is like, you know, 0.2, 0.25. So it's kind of maybe noisy oftentimes and so on. Here, this is I think it's as stark relationship as it gets. So what we do, we'll look at all Belgian firms in our data set. So it's exporters and importers. And when we split them by size. And so this is literally employment size. So these are firms less than 50 employees, less than 100 employees, and the biggest bin is more than 2,000 employees. These are Belgian, you know, Belgian firms, Belgian entities, full-time employees in Belgium, right? This could be bigger firms, but this is the employees in Belgium, right? And so what we see is that the small firms, you know, firms less than 100 employees, they really use euros. They use 80% of their exports are in euros. And again, this is outside of the European Union, right? So this is when the small firms export far away, right? And so they disproportionately really use the euro. And so as you get to large firms and very large firms, this is when the share of the euro falls below 40%. And this is where the dollar starts to play a huge role, right? So this two colors of blue is two types of dollar invoicing. And we split, you know, the case when we can clearly tell that it's dollar invoicing because it's to a country that does not peg to the dollar. And this is the use of dollar to a country that pegs to the dollar. So the starkest example is the United States. When you export to United States, you use the dollar oftentimes, but is it LCP or is it DCP, right? It's kind of hard to tell, right? And when countries have perfect pegs, it's hard to tell. And so the only times when we can, sort of see is when you use destination currency and, there is meaningful exchange rate variation, really, right? And so you see the small firms never use destination currency pricing, right? It only starts with firms more than 500 employees, and then you have a sensible, a chunk of firms that do in destination currency pricing. But what's interesting, if we exclude United States and dollar pegs, this is when trends become even more pronounced. These are kind of DCP firms. Dollar is concentrated in the range of firms, between 200 and 800, and then it's actually the destination currency pricing. So the largest firms, the very large firms, when you look at destinations like Japan, where there is meaningful exchange rate variation with the dollar as well, they actually use quite a lot of destination currency. And this is sort of like interesting for us. Look, this is exactly consistent with the theory. We're going to do it in a regression-based analysis. And you see it's exactly consistent with theory. The firms that have the strongest strategic complementarities are the ones that will have the strongest incentive to choose the destination currency pricing because they care about what their competitors are doing. And these are the large firms, right? The guys that do not care about their competitors and do not import in the destination currency will choose the euro, the producer currency. And this is exactly the small firms, right? The small firms import little from far away, and theory suggests they shouldn't care about what their competitors are doing. And it's not surprising that these firms are adopting the euro. And finally, the guys who have some strategic complementarities, but not too strong to choose the yen when they export to Japan, but they have some strategic complementarities and they import intermediate inputs. And a lot of intermediate inputs that they import are in dollars. Well, these are the guys that will intensively be using dollars in exports, right? And so this is kind of consistent with the theory. We do it in a regression-based analysis, and we put more variables, with all the correct fixed effects. But just to save time, I'm gonna not show the tables with the regression analysis. This is sort of the illustration of the results and sort of all these variables, the import intensity, strategic complementarities. Cross-border ownership would be another variable that matters. So they kind of show up in the regression analysis as well. But I think this is a good enough of an illustration. One thing I was going to say is obviously firm size correlates with a lot of things, right? So to the extent we can control for other things, we put them in the regressions and they matter on their own. This reduces somewhat the size relationship, right? Because if you put in, for example, import intensity, it will take away a piece of the size relationship when you put import intensity, because import intensity correlates with size, right? But it doesn't take away much from size, and size still matters. And so kind of the residual conjecture here is that it's either all happens through size and the effect on strategic complementarities, or we didn't manage to measure all the relevant variables. And the important variables are financial variables, which type of liabilities and in which currency do the firms have liabilities. And if financial liabilities are in dollars, and more so for large firms, that's another correlate of this firm size, which can correlate with currency choice away from euro. This is something we cannot do in this data. We don't have liabilities of firms in this data. There are other data sets to which we could connect, but it would be a small subsample of firms for which we can do it, and we would not have the currency information. So I know now in many countries people try to connect this data to the balance sheet of the firms to kind of try to study that connection, and sort of that's an open possibility, of course, at this point. We by no means rule that out. So, but this would all be projected on the firm size in our case. The very interesting thing is when you look at imports, there is no relationship of similar sort. So there is no firm size relationship with currency use in imports. And so, at first, when we were thinking about it, well, we were like, who chooses currency? Is it exporter? Is it importer? Is it a joint decision, right? So this is sort of an open question to some extent. It turns out that export currency choice correlates strongly with size. Import currency choice does not correlate with size of the firm, of the importer. To the extent firm size correlates with everything, right? If you don't find correlation with firm size, perhaps it would be hard to find strong predictor of import currency choice. So as a result, the way we're going to think about it, and this is sort of like a a conjecture that we cannot prove rigorously with our data, but I think it's a reasonable conjecture to have at this point, is that currency choice is chosen by exporters, and then importers take currency choice as given, they take prices as given, and they choose quantities. So basically, this is really the way our models work, right? The firms that export choose prices, and firms that import choose quantities, right? It seems to be not a terrible approximation to the data given what we know, but obviously, this is not a proof, right? So this is just a correlation at this point, but it seems reasonable to think about it for the time being. Okay, so I'm going to skip the tables as I promised you, and what I want to show you are the regressions for prices and quantities, how currency choice then sort of fits into dynamics of prices and allocations for these firms, for these exporters. So this is the table I want to focus on. So remember, this is exactly the regression specification that I wanted to estimate based on theory. So this alpha theory says should be 1. So this is like currency exchange rate pass-through for firms that choose euros for exports and don't import intermediate inputs and are small. So we will assume don't have strategic complementarity. So we would expect complete pass-through for these firms. I'm going to do this regression at 1 year horizon, and then I'm going to do it dynamically, right? And okay, so what do you find? Well, you actually do find 1. So this is our main regression specification. You do find exchange rate pass-through of 1 at 1 year horizon. These are for firms that price in euros, have no intermediate inputs, and are small, right? And this is exactly what the theory predicts. These firms should use euro, and they should be constant markup firms. So both in the short run, they should have complete pass-through, and in the long run, they should have complete pass-through. So when you take whatever horizon you want, like 1 year horizon, it should be complete pass-through as well, right? And so that, the theory works here. Next, we expect that the firms that use intermediate inputs, they have less pass-through of the dollar exchange rate. And the firms that price in non-euros, so indicator variable is equal to 1 if you use non-euro. This is non-euro, right? And so we expect those firms to have lower pass-through. And so this is variable here, and this is variable here. And, this is our preferred specification. And this is exactly what you find, is that if you use foreign intermediate inputs, you'll have less pass-through on the euro destination exchange rate. And if you choose other currency than euro for pricing, you will also have lower pass-through at annual horizon. And so now we know what that coefficient is supposed to be. It's supposed to be minus delta. And delta is degree of price stickiness. So what it says that roughly, 30% of prices have not adjusted yet at the annual horizon, right? So this is roughly the back of the envelope calculation here. But now we can go to the dollar stuff, and we can say, well, if you import intermediate inputs in dollars, and if you choose dollar to price your goods, this would be, this variable and this variable, well, you will have pass-through on the dollar exchange rate. And again, this thing is delta. And you kind of see how these two coefficients, we did not restrict them, but the two are quite close to each other. And so this is consistent with whether you do dollars, euros, or other currencies, you have similar extent of price stickiness measured by the delta coefficient, and it seems to be kind of similar. And also, you have this coefficient now on the dollar intermediate inputs, right? And so you are sensitive to the dollar exchange rate, even through the flexible price, determinant of how much you import. We could do stuff with market shares, right? So this is the stuff that we do with market shares here. And so in our data, it was interesting. Firm size was very strong predictor of currency choice, so of these variables, but it just doesn't seem to be statistically, we couldn't estimate it statistically significant for pass-through. So the theory predicts that, this should be negative and this should be positive, but we didn't get much of statistical significance here. So it might well be that just our proxies are too noisy to do it, because of course we only have, the market share piece from relative sales of Belgian firms, and we actually don't know the market share in the Japanese market. We don't know for the Belgian firm, because we actually don't know how much the Japanese firms sell in that market. We can only say that this Belgian firm is bigger than the other Belgian firm. In our previous analysis, this variable seemed to work pretty well. it could be that it worked because it predicts currency choice, like we kind of show in this paper, and then the currency choice predicts pass-through. That could be. But it also could be that we could just another paper could measure things better, right? For the market share variable. Okay, very good. Yeah, so there is a cute point, but I'm gonna make it. I mean, there is an interesting stuff you can learn from looking at pegged and non-pegged countries, and we describe it in the paper. And so this kind of, if you do the regression incorrectly, you're not gonna get this results. And so you kind of have to stick to the theory predicted regression. If you omit any of these variables, you get a bias. And this bias works in a very interesting way. So you can kind of see it here. Right? If you don't include the right variables, you're going to get strong downward bias on coefficients. And as soon as you include the dollar exchange rate, which should be there in the regression theoretically, you restore the size of the coefficient and the significance. And so this was kind of a fascinating finding for us, that we at first just ran regressions and we couldn't make sense of the results. We were thinking there is something funny between pegged and non-pegged countries. And then, we went to theory, and the theory told us which regression is correct. And once you do it, magic happens. So we kind of really liked it. Okay, and so I'm gonna use just a few more minutes and just show you the dynamic results. So now I'm gonna run literally the same regression, but using monthly data. And so I can do it at different horizons. So I will do it from 4 months to 24 months out. When you do it for less than 4 months, you have the timing issues because you don't know when the exchange rate shock happened, when price is adjusted within a month. So you kind of just get more noise. So starting from 4 months, the coefficients were not, precisely enough estimated, basically. Okay, so remember I told you that firm, the alpha types of firms, the ones that are in euros, have no intermediate inputs, are small, they should be constant pass-through at all horizons, independently whether it's short run, when prices are sticky, or long run, when prices are flexible. That's exactly what we see in the data. Those types of firms are always complete pass-through. So now the firms that price in non-euros have the dynamics of pass-through, and the gap here is exactly that delta H. Is the gap between the two is essentially the sticky price determinant, and that's something that should shrink over time. And we see exactly what happens, that in 4 months out, the gap is quite large, and it gradually shrinks to 24 months out. The question is, quantitatively, is it a big shrinking or small shrinking? And we can do the same for dollar firms, and then the comparison is to zero, because firms that don't price in dollars should not be sensitive to the dollar exchange rate, in the short run. And this is the firms that do price in dollars and how sensitive they are to the dollar exchange rate. And you see the same pattern. 4 months out, you're very sensitive to the exchange rate, and it gradually shrinks, right? It shrinks in half, roughly speaking, to 24 months out, right? And this is exactly what we would expect from sticky price determinants. That's exactly like, how it should be qualitatively, quantitatively. Oh, did I? Huh. Oh, this is the old. How did that happen? Sorry, okay. So I had another slide in which I had, and this is bad, in which I kind of overlapped the Calvo model. And so now, I compiled slides incorrectly. Oh, yes, I know what happened. Okay, but anyways, you'll have to look at the paper. So if you overlap the Calvo model, the Calvo line will look like this, actually. So the Calvo line works beautifully, at this horizon for our data. But then we have a bit of a gap here between the Calvo model and the very short run. So there is something interesting happening in the very short run, less than 6 months out, where our data has kind of like a faster reduction in the impulse response that the Calvo model will predict. But essentially at 12 months, it settles on the same line on which it would and so the same would be true here. So the Calvo line will look like this here, right? So that's what we showed in the paper. What happens in the short run could be that measurement error that I mentioned, or could be that the data is actually a mixture of more flexible firms that adjust very fast and less flexible firms that kind of are on that Calvo line. And so in the short run, you have this fast adjustment by a subset of firms, and that's why you depart from a single parameter Calvo line. You maybe need a mixture of firms with different Calvo parameters. I'm going to take 2 more minutes and I'm going to stop. So, so what are these lines? So these are the flexible price determinants. So in particular, this is how sensitive you are to the euro exchange rate if you import intermediate inputs from far away. And this is how sensitive you are to the dollar exchange rate if few important intermediate inputs in dollars. And so, what do we know about it? Well, we know that coefficient in front of them should be 1 minus delta, which should increase over time because delta shrinks over time, delta H, right? And so we do see that it increases, the point estimates increase here in absolute values. And this is again consistent with, flexible price determinants being more important. So what's interesting, and this is the slide that I'm missing, unfortunately, but we can do the same thing for quantities. We can do the same regression for quantities of firms. And what we find is a consistent pattern that, if exchange rate makes you charge high prices, so let's think about a dollar appreciation. Imagine that dollar appreciated and you are pricing in dollars. This will mechanically push your price up when you sell to Japan. So if you use dollars when you're selling from Belgium to Japan, appreciation of the dollar mechanically pushes your price up in the short run. That should push quantities down, because you have a higher relative price to the firms that do non-dollar pricing. So you should lose quantities relative to those firms, right? So the price effect is mechanical from price stickiness. The quantity adjustment is kind of endogenous response of importers that see that the price has changed, right? And so that's what we see in the data, but it happens with a lag. So the response of quantities goes exactly in the right direction, like a sticky price model will predict that, dollar appreciation pushes quantities down in relative terms for firms that were pricing in dollars. This effect gradually kind of builds up over time. In the short run, that effect is actually insignificant and it becomes quite large and significant 1 year out, right? And so if I kind of infer the quantity elasticity, so I had the picture to show you the quantity dynamics, but this is already the inference of quantity elasticities. In the short run, it's insignificant and quantity elasticity starts close to zero. But as you get out, the quantity elasticities become kind of quite significant. And so they reach, so here the quantity elasticity are like -2. And so for the literature, dynamically to get quantity elasticities greater than 1 in absolute value is actually quite difficult. And kind of we see why. Because if you did this regression at 1 year horizon, you'd get something borderline significant around 1. But the point is that you are mixing very small short run quantity elasticity and, quite large sort of, longer run elasticity, right? And so by the way, when we estimate this elasticity, we use sort of sticky prices as an instrument. So it's a response, it's the component that we use in our regressions is the one from, the sticky price behavior, right? So controlling for the flexible price adjustment. So this is sort of, you can interpret it that sticky price matters not just for prices, but also for quantity dynamics, this much out. So I'm done. One thing I was going to say, it's kind of pretty interesting test of sticky prices, something that you cannot do in a closed economy. You can only do in an open economy. So it's actually very interesting for people who work on, closed economy sticky price stuff. Actually, the open economy dimension is very important because inside a closed economy, you will not have variation by currency. The only reason we can estimate and claim that it's a causal effect of sticky prices because we can compare firms that are sticky in dollars with firms that are sticky in euros, with firms that are sticky in destination currency. And it's that relative effect between them on prices and associated effect on quantities that kind of is the proof of the presence of price stickiness, which there is no equivalent to which in the closed economy. So I'm done. To my summary slide. I mean, we discussed, that there are these two interesting currencies, the global kind of dominant dollar and the very important regional currency euro, with perhaps aspirations of becoming a dominant currency more globally, so that trade between independent pair of countries that have nothing to do with Europe would be denominated in euros as well. So it's interesting that the things that theory predicts should matter for currency choice do matter for currency choice. And then the theory is also consistent with sort of the way currency choice fits back into price and quantity dynamics. And it's sort of consistent with the sticky price view of currency choice. And so one thing that I was going to mention at the end is it's sort of kind of interesting that what we've done, we sort of looked at the contemporaneous equilibrium that we observe now in the last kind of 10 years of data. What would be super interesting is what will happen over the next 10 years. So in particular, you can imagine that China will stop pegging to the dollar, right? There would be more volatility in the renminbi exchange rate. Some firms will price more and more in the renminbi. Both the imported inputs would be in the renminbi and your competitors will be pricing in the renminbi potentially, right? And so all of the shifts would be kind of fascinating to observe perhaps over the next 10, 15, or 20 years, I mean, we can only kind of do prediction based on our general equilibrium models now, but soon we actually will have data to see how all this currency choice and pass-through dynamics would change as you change this general equilibrium environment going forward. And to me, this is kind of one of the exciting areas of future research. And I'll stop here.
Okay, thanks so much, Oleg. It was fascinating. So now we can move to the discussion by Giancarlo, and then I suggest we collect some questions from the floor.
How do I share the video?
I think now you can.
How do I do this? Share the video. Fantastic. Share the video, share screen. Starbucks. Okay. I guess you see it now, right?
Yes.
Yeah. So thank you for inviting me. This is a fantastic paper and a great fun. Everything disappeared from my table. It's fine. I'll do with my finger. So it was a pleasure to read and prepare these comments for this paper. It's definitely something that I would recommend everybody to. I just lost my Apple Pen, which is a disaster. Where did I go? Haha, disappear. Doesn't matter. So thank you for inviting me. It is a great paper. It is really a fantastic bringing together of many results in the literature with a new data set that has special feature. So to paraphrase Gita, is a paper about how firms position their products in the international price system, right? In which currency they post-communicate their prices and keep them relatively sticky, at least for some time. Mathematically is a little bit like choosing the constraint. If you can choose which constraint you want to put, and you think that you want to maximize the value of your firm, so you choose your constraint by basically choosing the degree, the indexing of your prices and demand to a change rate movement, right? Now, in partial equilibrium, this choice only affects basically the covariance between revenue and cost. In general equilibrium, we also have an effect on the discount rate, in principle, because we know transmission shocks are very different, and also optimal policy can be very different. So in a way, there is a little bit, I mean, what I'm saying to all the research of the central bank, for your own sake, there is a lot of work to do there, because there is also the general equilibrium effect to think about. And Dimitri and other people have already tried to close the circle there. But here, this paper is about the data set, right? So bringing theory to the data. With the usual caveats, unfortunately. One is 2 years of data, but hey, they had to beat the pack, right? They could not wait. Somebody else would have done it. So, maybe with 3 or 4 years would have been more interesting to see what happened. And the other one, unfortunately for everybody, unit values, not prices, coming from this kind of data set. And also, we should really, Oleg already said this, is really like testing and quantify the incidence of nominal rigidities at once, which I thought was cool, it was nice. Now, I got 4 comments, one on the model, another one on the interpretation, evidence, and what exactly are we identifying? What is ERPT here? So I like the paper. So if you ever hear me saying something that doesn't sound positive, is that you are not listening correctly. By the way, so if you look at the large area of research in the last few years, it's mostly been dominated by actors on Barnside, with the oligopolistic competition among producers of substitutes. A little bit is coming back now. One idea that I had a long time ago, with Luca actually had it at the Bank of Italy at the time. The idea that you also compete through vertical interactions, right? So you compete not naked. It's not out of the factory doors that you compete. You compete out of the retail door. And in the middle, you have the value chain and distribution. So we wanted to have this interaction. The reason why I'm bringing it up is that if you look at I'm going back and forth between my notation and Oleg notation, sorry for this, but if you look at the price at the retail level that you see in the middle of this thing, it is a price that, let me see if I could use my finger. Yes, I could do. So this price here, if you look at this price, you see that it's a price that includes the vertical interaction, includes the values. And when you go at the border, clearly when the firms preset the price, they know that whatever price movement they choose today will only be a fraction of the allocated price down the line. And this creates this markup. You see, the markup becomes variable, stay contingent, and include all in general, you think of double marginalization, no? You know, when you open the tap, you need to think about the whole hydraulic system before you go to the allocated price. So at the border, you already internalize this. Why am I saying this? Oops, come on. Because, you know, once you look at the kind of model that this approach gives you, it's very similar to Atkinson and Barnside, because you still have heterogeneity. You know, there is variable markups. The markup varies across industry. If you think of, you know, this elasticity of substitution may vary across, you know, high differentiated, low differentiated goods. It is also the markup is higher for larger firm, more productive firm, larger firm, higher markup. So it is like combined, it's sort of contiguous, no, to the Atkinson Barnes. I'm really excited by work I've been working for the last 3 years. The fact that you can actually work a combined model we call ABCD. Modestly is Atkinson Barnes like cost and distribution, because of Corsetti, the dollar, whatever. Luan has sort of done it. And we think that this model is actually very helpful because it sort of goes a little bit one step into filling the gap between the empirical evidence that tell us that things are less elastic than we think, and the model that tell us, you know, Atkinson Barnes elasticity, sometimes they go to infinity, enormous elasticity there. So, and for you as policy researcher, for those of you who are policy researcher, this is an issue, because if you ask about, you know, what is the effect of COVID, Brexit, if you have a model where elasticities are too high, first of all, your welfare valuation would be peanuts. And second, you will have a very counterfactual, you know, reorganization of value chain way beyond what you can see in the data. So why am I saying this? Because the empirical specification of the model, like Oleg and Mary and Joseph, they really use, I think, a general specification, but you can always find an additional bit there, right? So if you can find, for example, the non-tradable services here, or if you know, in principle, the model could be richer. And what is not known, and I spent, let me tell you, several months on this, there is a lot of heterogeneity that creates averaging problems. There is a lot of non-linearity. So when you write a model with heterogeneity, you need to worry about those things, because your estimates can be really off to what you think you're estimating. Huh? Think only about the log linear approximation is an issue when you bring it to the data. So I have one issue with the interpretation of optimal preset prices. I mean, Oleg did a great job to tell you, you know, this is actually a fantastic little page, not mine, there, how you choose the optimal price and optimal currency. I have a little bit, I have been, you know, for the last 20 years had an issue first with Charles' angle. So the math is perfect. You know, you choose the argument that minimizes the variance of that object there, which is basically the desired price. And then you set your desired price, basically averaging the expected desired price in the currency that you are evaluating, like whatever you want, the local currency dollar. Now, the problem of this thing, thinking in terms of variance, is that you're going to say, okay, if there is a gap between desired and effective price, then you have large profit losses, and that's bad. But actually, if there is a gap, you have large profit losses and large profit gains. So, and then there is always a smart person from macroeconomics that raises his hand and say, well, but profit function, actually you like uncertainty, you like variation in the profit function. The real issue is that volatility of these gaps reduces the value of the firm. And this was actually, he already told you, it's a second order Taylor expansion. This is what Oxford Rogoff in 2001 and me and Paolo show, the fact that basically if you fix a price, like in LCP, this is a graph in which you have supply, employment on the x-axis here, you have demand here, and think of these two lines, high productivity and low productivity, in a model log utility, linear utility of labor, you have a fixed optimal labor supply. So basically, the price should move to just make sure that everything is a full employment and markup are stabilized. When you have LCP in this model, basically you fix a price, and the way you fix a price, you try to basically get as close as possible to the optimal in the currency, right? Which in terms of employment gives you this kind of equivalence. You want to stabilize moment in which you are producing too much, moment in which you're producing too little, in such a way that you maximize the value of the firm. Now, this is basically the graphical second order Taylor expansion approximation. But the point for a model with one period sticky price, a little bit more complicated with Calvo, but more or less is the same idea. Now, what I want to say is that if you look at the covariance, that this is actually a fantastic little thing in the paper. This covariance is beautiful because it talks directly to the estimation. Right? It is indeed an ideal slope of an OLS. But if you write it a little bit more out, basically what you want is really the covariance of the desired price here and the change rate to be negative and less than the variance of the change rate divided by half to choose that particular currency. So, and this I think is a little bit of more into, so the covariance is nice for the link to the OLS. This is the way I think about it, because it's basically the more economic way of thinking about it. The example we have in the Handbook of Monetary Economics draws on monetary noise and says, suppose you live in a country where there is monetary noise, you can think that monetary expansion increases wages, there is inflation, and depreciate the change rate. If you set your price in peso, and you're a producer there, say peso because I think of Bolivia always when I think of this example. If you set your price in PCP, you are crazy because you're a sitting duck, right? You commit to sell at a producer prices where your marginal costs are going up and down. If you set your price in dollar, you're a genius, right? Because setting in dollar means that when wage rates are high, the currency depreciates, you get more money. Vice versa for those who live in the US. If the US manages to stabilize the marginal cost very well, as Dimitrios told you in the previous paper, right? Optimal. So he would do. So I think those two equations are the core of the theory, and they tell you two different things. I mean, it's the same equation. It's two ways of telling the same equation. One equation tells you something about your econometrics. The other equation tells you something about how would you tell the story. But definitely is not the variance, and especially the gap that moves. Again, the gap that moves create losses and gains. So it's really a story about that. Now, I just I reminded this many times to Oleg currency choice in indexing decision, this is a sentence from the, I completely agree, from the paper. If you want to go then ahead of data, as we did, as I did with Paolo a long time ago, to say, okay, let's do it, let's do an index in here, right? So you choose the index in here, and that becomes sort of almost a option value, right? So you choose the optimal index by basically making exactly the covariance between the marginal cost in the foreign currency indexed by the pass-through you choose, and the log of the change rate equal to 0. So when we wrote this paper, we thought, well, you know, when you do a catalog, you have fine prints. Say, look, I sell you at this price, but I may change it if the change rate moves a lot. That was sort of dismissed. Linda Goldberg and Tille took the idea and they say, why don't we do it with a bunch of currencies? And the story finished there. Now, it's true that in the Belgian data, they don't see anything close to this indexing. I mean, maybe you have seen it, but you're not written. You have this stability of currencies. But in the last few years in the UK data, we found quite a bit of evidence that sort of revitalized this hypothesis. And so the point is that it is true that invoicing currencies are pretty stable, but I would like to know, for example, in the any other currency for which we have data, whether the same pattern we find for the UK is there, which is firms use more than one currency data, which is fine. But what is interesting is that they use multiple currency of invoicing, even for the same product, the same date, I mean, the same year. So we don't know whether it's across different customers. They could segment customers, or there could be a strange contract with the customer. We don't know that because we don't have the identity of the buyer, right? But basically 50% of UK export to extra EU destinations have this kind of stuff. They have multiple. So I know that Mary, anytime I talk to Mary about this, Mary say, why don't you write to every single firm in the UK and tell them to apologize, because this should not be true. I mean, it's probably fine. It would be nice to see whether, I mean, it would be nice to see whether it's true or not. And a little bit also, we find that UK exporters switch currency of invoicing year on year. There is a little bit of dynamic, but it's the second part. I think, you know, I sort of like the idea that invoicing are pretty stable. What is strange is this coexistence of currency of invoicing. I would love to hear if there is any evidence for France about this. So this is just like the numbers. Let me split. Now, this is very nice in the paper. The evidence, this idea of the desired pass-through is very elegant. I write it here without the control for the endogeneity with the choice of the dollar, but the idea is that, you know, you can basically write up an empirical approach by thinking of how the desired price respond to the change rate, netting out the 100% with a component that has to do with the covariance of marginal cost to the change rate, with the change rate. And it's not, by the way, in general equilibrium, in partial equilibrium is import, right? But in general equilibrium could also be monetary policy. So it's, again, this is interesting because there are many things there. And then this idea of the strategic complementarity, which is the competitor price. This is a part of the paper that I like a lot because it's very elegant and very clear, we clearly explain. And this is something that I wanted to ask. So you do linear probability model for own euro versus others, dollars versus local. It would be, to me, natural doing also for dollar versus other. I'm sure you've done it, but I was just curious if there is a reason not to do dollars versus other invoicing. And it's actually intriguing to see the results because, of course, the import channel matters. We know that the firm employments matter. what is interesting is this asymmetry between Belgian export sales that are insignificant for the invoice choice and then significant in the pass-through. There's a nice footnote talking about an exclusion restriction that one could in principle, if you take this result very, very strongly, one could in principle use it, no, to think about the test. So, and also the FDI is sort of an interesting, so it's just like a very nice corroboration of many ideas that were around. They're all together, they're done well, and they're like sort of, here it comes with to the monetary policy and monetary interest here. So how much stickiness is there, right? Clearly stickiness should be taught within a in a model where you can somehow control for the endogenous choice of invoice. And indeed, there is this result that is, I found very good to think more about. So like controlling for this endogeneity, you get a stickiness that go from 20 to 30%, 35%, right? So it's there is more stickiness than we may think. And basically, you have the stickiness after you control for the incomplete RP3 that can be explained by real stuff like covariance of marginal cost and competitor price with the change rate. So Fabio, I saw Fabio there, he would say, cool. And then there is this dynamic estimation over 2 years, which is, again, a little bit 2 years of data, but what is interesting is that you have an expected duration of about 8 months, which is very cool. Now, always Fabio's style, cool and very cool. But the point is, it would be nice to see an exercise because I'm confused how you bring this model to macro. So when I did this exercise with Luca and Sylvain in the GME 2008, we just took the standard model and we sort of addressed the issue of Obser-Rogov that with too much LCP, you have this counterfactual correlation, right? Between, when the change rate depreciated, terms of trade appreciated, that's not in the data. And then we show that LCP is fine if you get enough adjustment of prices. No? And we got this 4 months. Now you have an expected duration of 8 months, but I don't think it's comparable, right? Because it's net of all the rest of the price adjustment. So it would be nice to do a small back on the envelope calculation. I think I'm getting out of the time, but I want to just finish on an important question. So think of the price as the markup over marginal cost, and when you adjust these two, you always adjust a common component and a destination-specific component, the essence of pricing to market, right? Now, in a balance panel, if I had a fixed effect at firm level, firm product level, I would basically eliminate marginal cost and common component of markup. This is the netter approach. Now, what they have, I don't think you can use the firm because limiting the data, right? But use industry level. Industry level fixed effect, they do something similar at industry level, right? So within industry variation is using for identification, but it includes firm product level deviation from industrial average. Now, if there is no firm heterogeneity, that's the same thing, but there is firm heterogeneity. So what I don't understand is how much of your identification is based on cross-sectional variance as opposed to intertemporal, because with my work with Lou and Meredith, we only went for the intertemporal rather than the cross-sectional. The cross-sectional I always found a little bit of a problem here. But it's true that either way, we should get very close to identify destination-specific adjustment in markup. Okay, so, and this is interesting because maybe, when you do quantities, you really compare quantities across destinations. So it's really the destination specific that we should see. But again, the comparison I'm not sure. I didn't have time enough to compare the identification, but it's an important issue here because you want remember also the question you may have from your governor. What happened if in this area? And again, it's an issue of adjustment, reaction of prices and quantities comparative across. So those are two notes and concern forward that I have. One problem is that the export destination markets, the set is quite variable. Firms actually actively choose not only currency of invoicing prices, but also where to sell. And it's never been really discussed, this selectivity bias. We have mixed evidence. We actually find quite a bit of selectivity bias, evidence of selectivity bias for large firms with market power, less so for firms selling low differentiation goods. But it could be important to, to correct, to get the right numbers. And also this issue of time variation versus cross-section to identify. The paper has been around for a bit, we are revising now. We use basically the trade pattern, selection pattern as an additional fixed effect. So let me conclude. I always look forward to see more the Amitco. They're writing faster than I can read, so I'm always frustrated. But I think this thing of cross-country comparison and time variation will be the next thing to do, which have obvious implication for theory and policy-oriented work. Thank you for having me.
Thank you, Giancarlo. So we are running a little bit out of time, but both the lecture and the discussion were so interesting that I couldn't stop them. So let's see if we can gather one or two questions from the floor, and then I will let Oleg reply to Giancarlo. So it seems like there are no questions from the floor. So Oleg, please, you can reply to Giancarlo.
Yeah, no, thanks so much. Giancarlo raised a number of interesting issues and points. I mean, I'd love to discuss a lot of them if we had time. Let me just choose a couple. I think we're on the same page on many of them. So actually, I should do a little more work with the distribution margin type of models that you brought up. I have a sense that indeed, as you're saying, they would fit exactly into the same framework, but it would be interesting. This is the class of models that we did not cover, but I actually fully agree that these are the important models with distribution margin. So in a way, in our handbook chapter with Gita and in our work with Dima, we always emphasize that probably a complete model in this area. So we focus on export prices at the border, but the complete model should probably involve an important distribution margin. That's kind of an essential input into modeling. And my sense is it will not change the estimating equations, but this is a important homework exercise for me to do for sure. Indexing is super interesting. I mean, the patterns that you find with Meredith and Lou, I guess, right? This is that paper. That firms tend to mix currencies is super interesting. We don't see it in Belgian data. No. We have now 4 years of data. It's still not 3.5 years. It's still not very long, but we don't have much, mixing either within a given period across destination of products, or we don't see actually much changes over time in this data. And so we don't know whether it's peculiarity of, the Belgian data, the UK data, or maybe other countries are somewhere in between. So indeed, looking in France would be super interesting. So in our data, like 85% of firms never mix currency in any dimension, basically. And then those that do, we calculate the weighted average, and it's like heavily weighted towards one currency still. So when we use a currency variable, it's not just 0-1, but it allows, like if you use 85% one currency, 15 other, turns out it's just heavily weighted towards either 0 or 1, and that's why we don't emphasize it quite as much. It kind of looks like not a bad approximation, but this is super fascinating. One last thing I was going to say, you brought up a lot of interesting things, but one thing I was going to say is variation that we use. And so we chose in this paper and in one other paper that we wrote, we chose to specifically focus within industry destination across firms. So all of the variation is cross-sectional across firm products within a given industry destination. the advantage of that, so this is one of the possible designs. An alternative design is to look at the same firm across multiple destinations, which has also been done in the literature. The reason we like our design, I mean, it's not always that one, but one advantage that it gives us is that we can control for general equilibrium, because we've put in the full set of industry, destination, time fixed effects. We kind of hold general equilibrium environment constant. So all our comparisons are within a given general equilibrium environment. And exactly what you brought up, like, you know, there could be a general equilibrium movement in wages, for example, but it's completely common across all firms. And so we control with it for fixed effects, right? And so as a result, we don't have to worry about, it's true, when you write a general equilibrium model, this general equilibrium feedback could be the major source of, you know, general equilibrium response. But here for empirical work, we can just offset it with fixed effects. And that's why we chose to do it. So all variation is actually really within industries, within destinations. So it's not like how the same firm charges different markups in different destinations. It's how firms of different size with different input intensity and with different currency choice, how do they have different price and quantity dynamics within a given destination, holding general equilibrium constant. So it's kind of like, that's why we can get closer to a causal claim that it's the causal impact of price stickiness, because we're really comparing two firms comparable on other dimensions in the same general equilibrium environment, so subject to the same general equilibrium shocks. Let me stop here. I mean, I wish we could continue the conversation, but I know we took too much time already.
Okay, so are there questions from the floor maybe? Just one last one? No? Okay, so I think we can close here.
I'll say
Yeah,
one more thing. Sorry.
Yeah,
so in
please.
terms of price stickiness, so Giancarlo pointed out that we estimate something between 8 and 9 months price stickiness. I would not take that number as like definitive in a way. I would think that this is sort of like the average that feeds the data. My guess is that in the data we have a mixture of sticky and more flexible firms. And so you probably have some firms that are much more flexible than 8 months and some firms that are much stickier than 8 months. But exactly as Giancarlo pointed out, we work with unit values. So we cannot really, you know, measure it. So we measure only an average number because of that. And so the aggregate data is kind of consistent with, you know, 9 months price stickiness. But I wouldn't use this like as a necessarily a single number, right?
But if I can add something, the quantity elasticity that they find is really cool. Because, you know, people working on this data set, they know how difficult it is to, there is a little bit of a quantity disconnect there. But let me stop here.
Yeah, it's a long conversation, which I would love to have, but I'm gonna restrain myself.
Okay, so I think we can close here. Thanks, Oleg, for the lecture. It was very nice having you. Thanks, Giancarlo, for accepting our invitation. And thanks to the speakers and participants of the previous workshop. So we will have new activities of the chair soon in the next month. Thank you all.
Thank you.
Thanks a lot, Francesco, for organizing.
Thank you, Oleg.